scalable VPN.
What matters isn't whether you're correct or incorrect, but rather the profit you earn when you're right and the loss you incur when you're wrong. Swing trading is a medium-term trading strategy that aims to capture price movements over several days to weeks. Unlike day trading, which involves closing all positions by the end of the trading day, swing traders hold positions for longer periods, taking advantage of market swings or price oscillations within a trend. This approach requires a balance of technical analysis, market knowledge, and timing to maximize gains while managing risks. A fundamental aspect of swing trading is identifying market trends and price patterns. Swing traders use various technical analysis tools, such as moving averages, Fibonacci retracement levels, and momentum indicators, to pinpoint potential entry and exit points. They look for signals that indicate the continuation or reversal of a trend. For instance, a swing trader might buy a stock that is bouncing off a support level or short sell a stock hitting resistance. Chart patterns like head and shoulders, flags, and double tops, bottoms are also integral to their strategy. Swing traders often combine technical analysis with fundamental analysis to increase the reliability of their trades. They might evaluate a company's earnings reports, economic data, or industry news to support their technical signals. By integrating both analytical approaches, swing traders aim to improve their chances of predicting price movements accurately. Risk management is crucial in swing trading, as positions are held for several days or weeks, exposing traders to overnight and weekend market risks. Swing traders typically use stop-loss orders to protect their capital from significant downturns. These orders automatically sell a position if it reaches a predetermined price, limiting potential losses. Position sizing is another key component, ensuring that no single trade can excessively impact the trader's portfolio. Patience and discipline are essential qualities for swing traders. Unlike scalpers or day traders who need to make quick decisions, swing traders must be willing to wait for their trade setups to materialize fully. This often involves enduring short-term market fluctuations without reacting impulsively. Staying disciplined to a trading plan and not deviating based on emotional responses is vital for success in swing trading. The flexibility of swing trading makes it suitable for individuals who cannot dedicate their entire day to monitoring the markets. It allows for a more balanced approach to trading, where decisions are made during less hectic periods. This aspect of swing trading can be particularly appealing to those with full-time jobs or other commitments. In summary, swing trading is a strategy designed to capture intermediate-term price movements within a market trend. It relies on a combination of technical and fundamental analysis to identify profitable trading opportunities. Effective risk management and a disciplined approach are essential to navigating the market's inherent volatility and achieving consistent returns. Swing trading offers a balance between the rapid pace of day trading and the long-term focus of investing, making it an attractive option for many traders. The gold game is on. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Gold's correlation with the Japanese yen, JPY, is an interesting dynamic in financial markets, reflecting the interplay between safe haven assets and global economic factors. Both gold and the yen are traditionally considered safe haven assets, meaning they are sought after during times of economic uncertainty or geopolitical instability. This shared status often leads to a notable correlation between the two, particularly in periods of market stress. One key aspect of the gold-yen correlation is their inverse relationship with the US dollar. When the dollar weakens, both gold and the yen typically strengthen. This happens because a weaker dollar makes gold cheaper for holders of other currencies, increasing demand. Similarly, the yen often appreciates as investors seek stability away from the dollar. Thus, during periods of dollar weakness, both gold and the yen tend to move in the same direction, reinforcing their correlation. The correlation is also influenced by global economic conditions. In times of global economic uncertainty, such as financial crises, political turmoil, or significant market volatility, investors flock to safe haven assets. During these times, both gold and the yen see increased demand. For instance, during the global financial crisis of 2008 and the market turmoil caused by the COVID-19 pandemic, both gold and the yen appreciated significantly as investors sought refuge from the instability in other markets. Monetary policy in Japan also plays a role in this correlation. The Bank of Japan's BOJ policies, particularly its stance on interest rates and quantitative easing, can affect the yen's value. When the BOJ implements ultra-loose monetary policies, it can lead to yen depreciation. However, if these policies are seen as stabilizing measures, the yen might still attract safe haven flows, maintaining its correlation with gold. Conversely, tightening policies can strengthen the yen, aligning its movement with gold if global uncertainties persist. Additionally, inflation expectations and real interest rates are crucial factors. Gold is often used as a hedge against inflation, while the yen, being a low-yielding currency, can be sensitive to changes in real interest rates. When real interest rates are low or negative, both gold and the yen become more attractive. This shared sensitivity to interest rate changes can lead to periods where their prices move in tandem. In summary, the correlation between gold and the Japanese yen is primarily driven by their roles as safe haven assets, their inverse relationship with the US dollar, and their sensitivity to global economic conditions and monetary policies. During times of market stress and economic uncertainty, both assets typically see increased demand, reinforcing their correlation. Understanding this relationship helps investors make informed decisions in times of economic volatility and uncertainty. Gold is working. Gold's high volatility offers numerous opportunities for traders to profit, provided they adopt the right strategies and risk management techniques. One effective approach is to engage in short-term trading strategies, such as day trading or swing trading, which allow traders to capitalize on the frequent price fluctuations within a day or over several days. By closely monitoring gold's price movements and employing technical analysis tools like moving averages, Bollinger Bands, and the Relative Strength Index, RSI, traders can identify potential entry and exit points. These tools help in predicting trend reversals or continuations, thus facilitating timely trades. Another method to leverage gold's volatility is through options trading. Options give traders the right, but not the obligation, to buy or sell gold at a predetermined price within a specified time frame. This can be particularly advantageous in volatile markets, as it allows traders to benefit from price swings without the need to hold the physical asset. Strategies such as straddles and strangles, which involve buying both call and put options, can be effective in capturing gains regardless of the direction in which gold prices move. The key is to anticipate significant price movements and structure option trades that can profit from such volatility. Additionally, using leveraged products like gold futures and leveraged ETFs, exchange-traded funds, can magnify potential returns from gold's price movements. These financial instruments allow traders to gain larger exposure to gold prices without needing to invest a large amount of capital upfront. However, it's crucial to manage the inherent risks associated with leverage, as it can also amplify losses. Traders should implement strict risk management practices, such as setting stop-loss orders and maintaining appropriate position sizes, to protect their capital. Furthermore, keeping abreast of global economic events and geopolitical developments is vital. Gold prices are highly sensitive to macroeconomic indicators, central bank policies, inflation rates, and geopolitical tensions. By staying informed about these factors, traders can anticipate periods of high volatility and adjust their trading strategies accordingly. For instance, during times of economic uncertainty or political unrest, gold often sees increased demand as a safe haven asset, leading to significant price movements. In summary, traders can take advantage of gold's high volatility by employing short-term trading strategies, using options and leveraged products, and staying informed about global economic and geopolitical developments. Effective risk management is essential in all these approaches to safeguard against potential losses and to ensure sustainable trading success. The gold market is going on. An interest rate cut typically has a significant impact on the price of gold, often leading to an increase in its value. This relationship stems from several interconnected economic factors that influence investor behavior and market dynamics. When central banks, such as the Federal Reserve, cut interest rates, the return on interest-bearing assets like bonds and savings accounts decreases. This reduction in yields makes these investments less attractive compared to non-yielding assets like gold. Consequently, investors often seek alternatives to preserve or grow their wealth, and gold becomes a more appealing option due to its historical role as a store of value. The increased demand for gold as an investment drives its price higher. Lower interest rates also typically lead to a depreciation of the national currency, in this case, the US dollar. A weaker dollar makes gold, which is priced in dollars, less expensive for buyers using other currencies. This increased affordability boosts international demand for gold, further contributing to a rise in its price. The inverse relationship between the dollar's strength and gold's price is a well-established market principle, where a decline in the dollar enhances gold's attractiveness as an investment. Additionally, an interest rate cut can signal concerns about economic growth and stability. During periods of economic uncertainty or downturns, central banks often reduce rates to stimulate the economy by encouraging borrowing and spending. In such scenarios, gold is perceived as a safe haven asset, providing a hedge against economic instability and inflation. As investors flock to gold to safeguard their investments, the heightened demand drives up its price. Moreover, lower interest rates can lead to higher inflation expectations. Gold is traditionally viewed as a hedge against inflation because its value tends to rise when the purchasing power of money declines. As inflation erodes the value of fiat currencies, gold maintains its intrinsic value, making it a preferred asset during inflationary periods. Therefore, expectations of rising inflation following an interest rate cut can increase investor demand for gold, pushing its price higher. In summary, an interest rate cut typically results in higher gold prices due to several factors: reduced attractiveness of interest-bearing assets, a weaker dollar, heightened demand for safe haven investments during economic uncertainty, and increased inflation expectations. These dynamics collectively make gold a more attractive investment, driving up its market value. Our expert advisor is active. The London and New York trading sessions are two of the most significant periods in the Forex market, each with unique characteristics that influence trading strategies and market behavior. Understanding the differences between these sessions can help traders optimize their activities and capitalize on the distinct opportunities each session presents. The London session, which runs from 8 a.m. to 4 p.m. Greenwich Mean Time, is the most active Forex trading period. London has historically been a major financial hub, and this session sees a high volume of transactions and liquidity. The London session overlaps with the Asian and New York sessions, making it a critical time for trading. During this period, traders can expect high volatility and significant price movements, especially in currency pairs involving the British pound, GBP, the euro, EUR, and the Swiss franc, CHF. Economic data releases from the UK and the Eurozone often impact market activity, and traders need to stay informed about these announcements to anticipate potential market shifts. Key features of the London session include its liquidity and the variety of trading opportunities available. The high trading volume means that orders are executed quickly and with minimal slippage. This liquidity also allows for tighter spreads, reducing trading costs. Additionally, many of the world's largest banks and financial institutions are active during this session, contributing to the deep liquidity and dynamic market movements. Traders can take advantage of the heightened volatility by employing strategies such as trend trading or breakout trading, which rely on significant price movements. In contrast, the New York session runs from 8 a.m. to 5 p.m. Eastern Standard Time. It begins as the London session is winding down, creating a period of overlap from 8 a.m. to 12 p.m. Eastern Standard Time, which is one of the most active times in the Forex market. The New York session is influenced heavily by economic data releases from the United States, including reports on employment, GDP, and consumer sentiment. These releases can cause sharp market movements, particularly in USD currency pairs. The New York session is also known for its volatility, but it tends to be driven by different factors compared to the London session. The focus shifts more towards U.S. economic news and developments, which can create significant trading opportunities. Major U.S. financial institutions and hedge funds are highly active during this time, contributing to large trade volumes and liquidity. The New York session's impact on market sentiment can be profound, often setting the tone for the rest of the trading day. One key aspect of the New York session is the afternoon lull that can occur after the London market closes. This period may see reduced volatility and lower trading volumes as European traders exit the market, leading to quieter market conditions. However, this can also be an opportunity for traders to reassess positions and plan for potential movements when the Asian markets open. In summary, the London and New York trading sessions are pivotal periods in the Forex market, each with its own dynamics and opportunities. The London session is characterized by high liquidity, volatility, and significant price movements influenced by European economic data. The New York session, while also volatile, is heavily driven by U.S. economic releases and can set the stage for market trends. Traders should tailor their strategies to the unique conditions of each session, leveraging the periods of high activity and adjusting to the shifts in market behavior as the sessions overlap and transition. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. News trading is a strategy employed by traders to capitalize on market volatility triggered by economic reports, geopolitical events, and other significant news releases. This approach leverages the swift and often substantial price movements that follow major news events, aiming to profit from the market's reaction to newly available information. News trading can be applied across various markets, including forex, stocks, and commodities, but it requires a solid understanding of the news events that drive market behavior and the ability to act quickly. Economic indicators such as employment reports, inflation data, central bank announcements, and GDP figures are among the most influential news events in financial markets. These reports provide insights into the health of an economy and can lead to rapid price adjustments as traders and investors digest the new data. For instance, a stronger than expected jobs report might lead to an appreciation of a country's currency as it signals economic strength, while a disappointing report might cause a sell-off. Traders who can accurately predict or swiftly react to these outcomes can exploit the resultant price movements. Geopolitical events, including elections, policy changes, and international conflicts, also play a crucial role in news trading. Such events can create significant uncertainty and market turbulence. For example, unexpected election results or sudden geopolitical tensions can lead to sharp market movements as investors reassess risks and adjust their portfolios. News traders must stay informed about global events and be prepared to act on news that could impact the markets. The key to successful news trading lies in preparation and speed. Traders typically use an economic calendar to track upcoming news events and set up alerts to stay informed. Advanced trading platforms offer features like one-click trading and high-speed order execution, which are essential for capturing opportunities in the fast-moving markets following a news release. Additionally, traders often use technical analysis to identify key support and resistance levels, helping them to set entry and exit points ahead of the news. However, news trading also involves significant risks. Market reactions to news can be unpredictable and volatile, leading to potential slippage and unexpected losses. The initial market reaction may be followed by rapid reversals, making it challenging to secure profits. To mitigate these risks, traders use risk management tools such as stop-loss orders and position sizing to protect against adverse price movements. Moreover, understanding market sentiment and the context of the news is crucial. The same piece of news can have different impacts depending on the broader economic environment and market expectations. For example, a central bank rate hike might be bullish for a currency in a strong economic context but could be seen as a negative move if the economy is perceived to be weakening. In summary, news trading is a dynamic and potentially profitable strategy that exploits market volatility induced by significant news events. It requires thorough preparation, quick decision-making, and effective risk management. Traders who master the art of interpreting news and its impact on markets can capitalize on the rapid price movements that follow major announcements, turning timely information into trading opportunities. Our expert advisor is reading candles formed by the market. The world of forex trading has seen a number of highly successful traders who have amassed substantial fortunes through their skills and strategies. Among these elite traders, George Soros is often cited as the richest and most famous forex trader. Soros, a Hungarian-American billionaire, is renowned for his prowess in the financial markets and his daring speculative bets. George Soros's most notable achievement in forex trading occurred in 1992, when he made a legendary trade that earned him the title, "The Man Who Broke the Bank of England." On September 16, 1992, a day now known as Black Wednesday, Soros's hedge fund, the Quantum Fund, bet heavily against the British pound. At the time, the United Kingdom was part of the European Exchange Rate Mechanism, ERM, which pegged the pound to the German mark. Soros believed the pound was overvalued and that economic conditions in the UK would force it out of the ERM. His massive short position on the pound, reportedly worth $10 billion, resulted in a profit of approximately $1 billion when the British government was forced to devalue the pound and exit the ERM. This single trade not only cemented Soros's reputation as a master forex trader but also significantly increased his wealth. His success has been attributed to his deep understanding of economic fundamentals, his ability to anticipate market movements, and his willingness to take significant risks. Soros's approach to trading combines macroeconomic analysis with speculative strategies, enabling him to identify and exploit market inefficiencies. Beyond the Black Wednesday trade, Soros has continued to be an influential figure in the financial world. He has authored several books on investing and finance, sharing his insights and philosophies with a broader audience. Additionally, Soros is known for his philanthropic activities, having donated billions of dollars to various causes through his Open Society foundations. While George Soros is often highlighted as the richest forex trader, other notable figures have also achieved remarkable success in forex trading. His audacious and highly profitable bet against the British pound in 1992. His success in forex trading is a testament to his exceptional analytical skills, strategic foresight, and willingness to take calculated risks. Soros's legacy in the forex market continues to inspire and influence traders around the world. You don't need to be a rocket scientist. Just cut your losses and then trust the process. Scalping is a trading strategy focused on profiting from small price changes in financial markets, typically by making numerous trades within a single day. This approach requires a high level of discipline, quick decision-making, and the ability to execute trades swiftly. Scalpers aim to capitalize on tiny market movements, often holding positions for just seconds or minutes, and rely on the cumulative gains from many small trades to achieve significant overall profits. The primary characteristic of scalping is the high frequency of trades. Scalpers may execute dozens or even hundreds of trades in a single trading session. To do this effectively, they utilize advanced trading platforms that offer fast order execution and low latency. Scalping often involves leveraging small price differentials, so even minor delays in trade execution can impact profitability. High liquidity is another essential factor, as it ensures that scalpers can enter and exit positions quickly without significant price slippage. Technical analysis plays a crucial role in scalping. Scalpers rely heavily on charts, technical indicators, and patterns to identify entry and exit points. They use tools such as moving averages, Bollinger Bands, and Relative Strength Index, RSI, to make informed decisions. Short-term trends, support and resistance levels, and market sentiment are also key considerations. Given the rapid pace of scalping, traders need to be adept at reading charts and making quick judgments based on their analysis. Risk management is paramount in scalping due to the high volume of trades and the potential for rapid market fluctuations. Scalpers use strict stop-loss orders to limit their losses on any single trade. Since the profit margin per trade is minimal, controlling losses is essential to maintaining overall profitability. Scalpers also tend to use small position sizes relative to their account balance, which allows them to absorb potential losses without significantly impacting their capital. Scalping can be mentally and physically demanding. The need for constant vigilance and quick reflexes can lead to trader fatigue, making it challenging to maintain focus over long periods. Scalpers must be prepared to spend extended hours monitoring the markets, and they often operate during peak trading hours when volatility and liquidity are highest. This intensive level of activity requires not only skill and experience but also stamina and concentration. In addition to technical factors, scalpers must also stay attuned to news and economic events that can cause sudden market movements. Even minor news releases or unexpected announcements can create opportunities or risks, so having access to real-time news feeds and staying updated on market developments is crucial. Scalpers must be able to react instantly to news that can affect their positions, further emphasizing the need for speed and efficiency. In summary, scalping is a fast-paced, high-frequency trading strategy that aims to take advantage of small price movements. It requires a robust trading platform, advanced technical analysis skills, and stringent risk management practices. While it offers the potential for significant profits through the accumulation of small gains, it also demands intense focus, discipline, and the ability to react swiftly to changing market conditions. Scalping is best suited for experienced traders who can handle the pressures and demands of this rigorous trading approach. The market is in its dynamics. Several countries are prominent in the global production of gold, each contributing significantly to the overall supply. Among the leading gold producers, China stands out as the largest, consistently topping the list for over a decade. China's dominance in gold production is attributed to its vast mining infrastructure, advanced technology, and extensive deposits primarily located in provinces such as Shandong, Henan, and Inner Mongolia. The country produces around 370 to 400 metric tons annually, making up a substantial portion of the global supply. Australia is another major player in the gold mining industry, often ranking second in global production. The country benefits from rich mineral reserves and a well-established mining sector. Key mining regions include Western Australia, which hosts some of the world's largest and most productive gold mines like the Superpit and Boddington. Australia's gold production contributes significantly to its economy, with annual output ranging between 320 to 330 metric tons. Russia also plays a critical role in the global gold market, consistently producing large quantities of the precious metal. Russian gold mining is primarily concentrated in Siberia and the Far East regions, with significant contributions from mines in Magadan, Amur, and Krasnoyarsk. Russia's annual gold production hovers around 300 metric tons, and the country has been steadily increasing its output over the years, driven by both domestic demand and export opportunities. The United States is another key gold-producing nation, with significant contributions from states like Nevada, Alaska, and Colorado. Nevada, in particular, is renowned for its rich gold deposits and is home to some of the largest mines in the world, including the Carlin Trend, which produces a significant portion of the country's gold. The U.S. produces approximately 190 to 200 metric tons of gold annually, with production levels influenced by market conditions and mining policies. South Africa, once the world's largest gold producer, remains a significant contributor despite a decline in production over the past few decades. The country's gold mines are primarily located in the Witwatersrand Basin, which has historically been the richest gold-producing region globally. South Africa produces around 100 to 120 metric tons of gold annually, and while its output has decreased, the country still holds substantial reserves. Other notable gold-producing countries include Canada, Peru, and Indonesia, each contributing substantially to global gold supply. Canada, with its prolific mines in Ontario and Quebec, produces around 180 to 190 metric tons annually. Peru, known for its rich Andean gold deposits, produces approximately 130 to 140 metric tons. Indonesia, with significant mining operations on the islands of Sumatra and Borneo, produces about 100 to 110 metric tons annually. In summary, the global gold production landscape is dominated by a few key countries: China, Australia, Russia, the United States, and South Africa, each with unique geological advantages and mining infrastructures. These nations, along with other significant producers like Canada, Peru, and Indonesia, collectively shape the supply dynamics of the gold market, influencing prices and availability worldwide. To new traders, I advise to start small. Begin with a small trading account and gradually increase your position sizes as you gain experience and confidence. Avoid big positions, as it can amplify both gains and losses. Taking a sniper entry in gold trading involves precision and strategic planning to capitalize on optimal entry points for maximum profit. This approach requires a deep understanding of technical analysis, market sentiment, and effective risk management. Here are the key steps to achieve a sniper entry in gold. 1. Identify key levels. Begin by identifying key support and resistance levels on the gold price chart. These levels are crucial as they represent points where the price has historically reversed or consolidated. Support levels indicate where buying interest is strong enough to halt a downtrend, while resistance levels indicate where selling pressure is strong enough to cap an uptrend. 2. Use trend lines and channels. Draw trend lines and channels to visualize the direction of the market and potential reversal zones. Trend lines connect the lows in an uptrend or the highs in a downtrend, providing a clear indication of the market's direction and potential breakout points. 3. Employ technical indicators. Utilize technical indicators such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands. The RSI helps identify overbought or oversold conditions, the MACD signals potential trend reversals, and Bollinger Bands highlight periods of high or low volatility. 4. Recognize candlestick patterns. Pay attention to candlestick patterns such as pin bars, engulfing patterns, and doji. These patterns often indicate a reversal or continuation of the trend and can be effective in pinpointing precise entry points. For example, a bullish engulfing pattern at a support level might signal a strong buying opportunity. 5. Monitor market sentiment. Keep an eye on market sentiment indicators and news events that could impact gold prices. Economic reports, geopolitical tensions, and central bank policies can all influence investor sentiment and lead to significant price movements. 6. Wait for confirmation. Patience is crucial for a sniper entry. Wait for the price to reach key levels and observe how it reacts. Look for confirmation through candlestick patterns, technical indicators, and volume spikes. Entering a trade without confirmation increases the risk of false breakouts or reversals. 7. Use limit orders. Consider using limit orders to set your entry point at a specific price level. This allows you to enter the market at your desired price without needing to constantly monitor the charts. Limit orders can be particularly useful when targeting entries at key support or resistance levels. 8. Implement strict risk management. Set stop-loss orders to protect against unexpected market movements. Position your stop-loss below support levels in long trades or above resistance levels in short trades. This ensures that your risk is limited if the trade does not go as planned. 9. Calculate position size. Determine your position size based on your risk tolerance and the distance between your entry point and stop loss. This ensures that you are not risking more than a predetermined percentage of your trading capital on any single trade. 10. Review and adapt. Continuously review your trading strategy and outcomes. Adapt your approach based on market conditions and past performance. Learning from both successful and unsuccessful trades helps refine your sniper entry technique over time. Example scenario. Suppose you identify a strong support level at $1,800 per ounce for gold. The price approaches this level, and you notice a bullish pin bar forming on the daily chart, indicating a potential reversal. The RSI is also showing oversold conditions, and the MACD is starting to turn bullish. You set a limit order slightly above the support level at $1,805, with a stop loss at $1,790 to limit your risk. Your target is a resistance level at $1,850. By combining technical analysis, candlestick patterns, and risk management, you execute a sniper entry that maximizes your potential for profit while minimizing risk. In summary, taking a sniper entry in gold trading requires careful analysis, patience, and disciplined risk management. By focusing on key technical levels, waiting for confirmation, and implementing strict risk controls, traders can enhance their chances of entering the market at optimal points and achieving successful trades. Our expert advisor is analyzing candles formed by the market. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a forex trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from forex trading. And after getting the skill of earning, you should try to become rich or millionaire by forex trading. But if you directly want to achieve third level, you can never be profitable. The forex market is very uncertain. There is no strategy that is always 100% profitable. Risk management, Proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a Forex trader, and that's the beauty of Forex trading. The key points of my trading strategy are as under. I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of Forex. That's why I believe software tools are necessary in Forex trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come anytime. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break-even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Light discussion goes on. A double bottom pattern is a bullish reversal pattern that often signals the end of a downtrend and the beginning of an uptrend. This technical analysis pattern is characterized by two distinct lows at approximately the same level, separated by a moderate peak in between. It resembles the letter W and indicates that the asset's price has found a support level twice, suggesting a potential reversal in market sentiment from bearish to bullish. The formation of a double bottom pattern typically occurs over a longer time frame, which can range from several weeks to several months. The first bottom forms as the price declines and hits a support level, where buying interest begins to outweigh selling pressure, causing a temporary price increase. This increase leads to the formation of the peak, or resistance level, as the price encounters selling pressure once again. The second bottom forms when the price drops back to the support level, finding buyers once more. The key aspect of this pattern is that the second bottom should be at a similar price level as the first, confirming the support. For traders and analysts, the double bottom pattern is significant because it suggests a shift in market dynamics. The completion of the pattern is confirmed when the price breaks above the resistance level formed by the peak between the two bottoms. This breakout is typically accompanied by increased trading volume, reinforcing the bullish signal. Once the breakout occurs, traders often anticipate a continued upward movement, with the price potentially reaching the level equivalent to the height of the pattern projected from the breakout point. However, it's essential to note that the double bottom pattern is not foolproof and can sometimes lead to false signals. Traders should use it in conjunction with other technical indicators and analysis to confirm the validity of the pattern. Additionally, monitoring trading volume during the formation and breakout can provide further insights into the strength of the reversal. Low volume during the breakout, for instance, may indicate a lack of conviction among traders and the potential for the pattern to fail. In summary, the double bottom pattern is a reliable indicator of a potential trend reversal from bearish to bullish. Its formation involves two similar price lows separated by a peak, with confirmation coming from a breakout above the peak resistance level. While it offers valuable insights, it should be used alongside other analysis tools to ensure accurate trading decisions. The primary goal of a successful trader is to execute optimal trades. Money is secondary. Weekend gap trading is a strategy employed by traders to capitalize on price gaps that occur between the closing price on Friday and the opening price on Sunday or Monday in financial markets. These gaps are created because, while trading activities cease over the weekend, economic and geopolitical events continue to unfold, often leading to significant changes in market sentiment and asset prices by the time markets reopen. This phenomenon is particularly common in forex and stock markets, where continuous global developments can create notable discrepancies between closing and opening prices. The essence of weekend gap trading lies in predicting the direction of these gaps and positioning trades accordingly. Traders analyze a range of factors to forecast potential gaps, including economic indicators released over the weekend, political developments, natural disasters, or major news events. For instance, an unexpected election result or a natural disaster can significantly impact market sentiment, leading to a pronounced opening gap. By anticipating these events, traders can enter positions at the close of the market on Friday or at the open on Sunday or Monday to exploit the price difference. There are two primary types of gaps that traders focus on: gap up and gap down. A gap up occurs when the opening price is higher than the closing price of the previous session, while a gap down occurs when the opening price is lower. Traders use various technical analysis tools to identify potential gaps, such as support and resistance levels, trend lines, and chart patterns. Historical data and past market behavior also play a crucial role in forming gap trading strategies, as they provide insights into how similar events have impacted prices in the past. However, weekend gap trading comes with its set of risks. One significant risk is the unpredictability of market reactions to news events. Even with thorough analysis, the market's response to an event can be contrary to expectations, leading to potential losses. Additionally, the illiquid nature of the market at the opening can result in slippage, where the execution price differs from the intended price. To mitigate these risks, traders often use stop-loss orders to limit potential losses and carefully manage their position sizes. Overall, weekend gap trading can be a profitable strategy for those who can accurately anticipate market movements based on weekend events. It requires a deep understanding of global economic and political developments, proficiency in technical analysis, and a robust risk management approach. By effectively combining these elements, traders can potentially take advantage of the price discrepancies that occur as markets react to news and developments over the weekend. Gold market is on the move. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Trend lines are a fundamental tool in technical analysis, used by traders to identify and confirm market trends. These lines are drawn on price charts to connect a series of highs or lows, providing a visual representation of the direction and strength of a trend. By offering insights into potential support and resistance levels, trend lines help traders make informed decisions about entry and exit points in the market. To draw a trend line, a trader begins by identifying significant peaks and troughs on a price chart. In an uptrend, the trend line is drawn by connecting a series of ascending lows, creating a support line that slopes upwards. This line suggests that as long as prices remain above it, the uptrend is likely to continue. Conversely, in a downtrend, the trend line connects descending highs, forming a resistance line that slopes downwards. This indicates that the downtrend is intact as long as prices stay below the line. Trend lines are valuable for their ability to highlight the overall direction of the market. An upward sloping trend line indicates a bullish trend, suggesting that buyers are in control and prices are likely to continue rising. A downward sloping trend line signifies a bearish trend, indicating that sellers are dominant and prices may keep falling. By identifying these trends, traders can align their strategies with the prevailing market direction, increasing the likelihood of successful trades. One of the key benefits of trend lines is their role in identifying potential support and resistance levels. In an uptrend, the trend line acts as a support level, where prices are likely to bounce back up after touching the line. This provides traders with potential entry points for long positions. In a downtrend, the trend line serves as a resistance level, where prices may face selling pressure and decline after approaching the line, offering potential entry points for short positions. Trend lines can also signal potential trend reversals. When the price breaks through a well-established trend line, it often indicates a shift in market sentiment. For example, a break below an upward-sloping trend line may signal the end of an uptrend and the beginning of a downtrend. Traders use this information to exit existing positions or initiate new trades in the direction of the emerging trend. Confirming the breakout with additional technical indicators, such as volume or momentum oscillators, helps reduce the risk of false signals. In addition to their simplicity and visual clarity, trend lines are versatile and can be applied across various timeframes, from short-term intraday charts to long-term monthly charts. This flexibility allows traders to use trend lines in conjunction with other technical analysis tools to enhance their trading strategies. For instance, combining trend lines with moving averages, Fibonacci retracement levels, or candlestick patterns can provide a more comprehensive view of the market and improve decision-making. In summary, trend lines are a crucial element of technical analysis, offering valuable insights into market direction, support and resistance levels, and potential trend reversals. By drawing trend lines on price charts and using them in conjunction with other analytical tools, traders can make more informed trading decisions, align with prevailing trends, and identify optimal entry and exit points. The simplicity, versatility, and effectiveness of trend lines make them an indispensable tool for traders of all experience levels. You cannot take home some money daily without a favorable risk-reward ratio. Trading trend reversals involves identifying and capitalizing on points where a market trend changes direction. This strategy requires a blend of technical analysis, patience, and discipline to accurately spot these critical junctures. Here's a detailed guide on how to effectively trade trend reversals. Firstly, identifying potential trend reversals begins with recognizing the current trend. Traders use trend lines, moving averages, and other indicators to determine if the market is in an uptrend, downtrend, or sideways movement. An uptrend is characterized by higher highs and higher lows, while a downtrend shows lower highs and lower lows. A trend reversal occurs when these patterns are disrupted, signaling a change in market sentiment. One of the most reliable tools for spotting trend reversals is the use of technical indicators and chart patterns. Indicators like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands can provide clues about overbought or oversold conditions, which often precede reversals. For example, if the RSI indicates an overbought condition in an uptrend, it could suggest an impending downward reversal. Similarly, chart patterns such as head and shoulders, double tops, and double bottoms are classic signals of potential reversals. A head and shoulders pattern, for instance, typically marks the end of an uptrend and the beginning of a downtrend. Candlestick patterns also play a crucial role in identifying reversals. Patterns such as the hammer, inverted hammer, engulfing patterns, and doji are often seen at the end of a trend and indicate a potential reversal. For example, a hammer candle at the bottom of a downtrend suggests that buyers are stepping in, potentially reversing the trend. Confirmation of these patterns is critical, which usually involves subsequent price action validating the reversal signal. Once a potential reversal is identified, confirmation is necessary before entering a trade. Confirmation can come in the form of a significant price movement in the opposite direction of the current trend, often accompanied by increased trading volume. For example, after identifying a head and shoulders pattern, a trader might wait for the price to break below the neckline with high volume before considering it a confirmed reversal. Risk management is paramount when trading trend reversals due to their inherently risky nature. Traders should always set stop-loss orders to limit potential losses. These stops are typically placed above resistance levels in a downtrend or below support levels in an uptrend. Additionally, position sizing should be carefully considered to ensure that any single trade does not excessively impact the overall trading portfolio. Lastly, patience and discipline are essential in trend reversal trading. It's important to wait for clear signals and confirmation before acting. Prematurely entering a trade can lead to false signals and losses. Traders should also remain flexible and ready to adjust their strategies as new market information becomes available. In summary, trading trend reversals involves recognizing current trends, using technical indicators and patterns to identify potential reversals, confirming these signals, and implementing strict risk management practices. By following these steps with patience and discipline, traders can effectively capitalize on trend reversals and enhance their trading performance. The market is in work. China's relationship with gold is multifaceted and strategically significant, reflecting its economic aspirations and historical affinity for the precious metal. As one of the world's largest producers, consumers, and holders of gold, China plays a pivotal role in the global gold market. China is the largest producer of gold globally, with extensive mining operations spread across the country. The Chinese government has encouraged domestic gold production to reduce reliance on foreign sources and to support the local economy. The development of the gold mining industry is part of China's broader strategy to strengthen its position in the global commodities market. This robust production capacity ensures that China has a steady supply of gold, bolstering its reserves and contributing to its economic stability. On the consumption side, China is also the largest consumer of gold, driven by both cultural and economic factors. Gold holds a significant place in Chinese culture, symbolizing wealth, prosperity, and good fortune. This cultural affinity is evident in the high demand for gold jewelry, particularly during festivals and weddings. Additionally, Chinese investors view gold as a safe haven asset, especially in times of economic uncertainty or when there are concerns about the stability of the financial system. This dual demand from both the retail and investment sectors underscores the importance of gold in the Chinese economy. The People's Bank of China, PBOC, China's central bank, plays a crucial role in managing the country's gold reserves. Over the past decade, the PBOC has significantly increased its gold holdings as part of a strategy to diversify its foreign exchange reserves and reduce reliance on the US dollar. By holding substantial gold reserves, the PBOC aims to enhance China's financial security and stability. These reserves act as a buffer against economic volatility and potential currency devaluation. The PBOC's consistent accumulation of gold has also been interpreted as a move to bolster the yuan's credibility and facilitate its acceptance as a global reserve currency. In addition to managing reserves, China has developed a sophisticated gold trading infrastructure. The Shanghai Gold Exchange, SGE, is one of the largest gold exchanges in the world, providing a transparent and regulated marketplace for gold trading. The SGE has introduced several initiatives to internationalize gold trading, including the establishment of the Shanghai Free Trade Zone, which allows foreign investors to trade gold on the exchange. These efforts are part of China's broader strategy to exert greater influence over the global gold market and to promote the yuan in international transactions. China's Belt and Road Initiative, BRI, also has implications for the gold market. As part of this extensive infrastructure and economic development project, China is investing in numerous countries that are significant gold producers. These investments often include the development of mining projects, which can increase China's influence over global gold supplies and enhance its strategic interests. Moreover, China's approach to gold reflects its long-term economic strategies. By accumulating gold, promoting its domestic market, and enhancing its trading infrastructure, China aims to safeguard its economic interests and assert its influence in the global financial system. This strategic orientation towards gold is consistent with China's broader goals of achieving economic resilience and reducing vulnerability to external economic shocks. In summary, China's involvement with gold is comprehensive, encompassing production, consumption, reserve management, and trading infrastructure. The country's strategic approach to gold underscores its importance in China's economic policy and its efforts to enhance financial stability and global influence. This multifaceted engagement makes China a key player in the global gold market, with significant implications for global economic dynamics. The three principles of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these principles, you are on right track. A double top pattern is a bearish reversal pattern that typically signals the end of an uptrend and the potential beginning of a downtrend. This technical analysis pattern is characterized by two distinct peaks at approximately the same price level, separated by a moderate trough in between. It resembles the letter M and indicates that the asset's price has encountered a resistance level twice, suggesting a shift in market sentiment from bullish to bearish. The formation of a double top pattern usually occurs over an extended period, ranging from several weeks to several months. The first peak forms as the price rises and hits a resistance level, where selling pressure begins to outweigh buying interest, causing a temporary price decline. This decline leads to the formation of the trough, or support level, as the price encounters buying pressure once again. The second peak forms when the price rises back to the resistance level, finding sellers once more. The key aspect of this pattern is that the second peak should be at a similar price level as the first, confirming the resistance. For traders and analysts, the double top pattern is significant because it suggests a shift in market dynamics. The completion of the pattern is confirmed when the price breaks below the support level formed by the trough between the two peaks. This breakdown is typically accompanied by increased trading volume, reinforcing the bearish signal. Once the breakdown occurs, traders often anticipate a continued downward movement, with the price potentially reaching the level equivalent to the height of the pattern projected from the breakdown point. However, it's important to note that the double top pattern is not infallible and can sometimes lead to false signals. Traders should use it in conjunction with other technical indicators and analysis to confirm the validity of the pattern. Additionally, monitoring trading volume during the formation and breakdown can provide further insights into the strength of the reversal. Low volume during the breakdown, for instance, may indicate a lack of conviction among traders and the potential for the pattern to fail. In summary, the double top pattern is a reliable indicator of a potential trend reversal from bullish to bearish. Its formation involves two similar price peaks separated by a trough, with confirmation coming from a breakdown below the trough support level. While it offers valuable insights, it should be used alongside other analysis tools to ensure accurate trading decisions. First plan your trades, and then trade according to your plan. No need to rush. MetaTrader 4, MT4, and MetaTrader 5, MT5, are two of the most popular trading platforms developed by MetaQuote software, catering to Forex, commodities, and other financial markets. While both platforms offer robust tools for trading and analysis, they have distinct differences that may influence a trader's choice based on their specific needs and trading strategies. MetaTrader 4 is renowned for its user-friendly interface and reliability, making it the go-to platform for many Forex traders. Launched in 2005, MT4 has become a staple in the trading community due to its simplicity, extensive charting tools, and a vast library of custom indicators and automated trading systems known as expert advisors, EAs. Its ease of use makes it particularly appealing to beginners, while its depth of features satisfies the needs of experienced traders. MT4 supports multiple order types, advanced charting capabilities, and a wide range of analytical tools, making it a versatile choice for technical analysis and strategy development. MetaTrader 5, introduced in 2010, is the more advanced successor to MT4, offering several enhancements and additional features. MT5 is designed to provide a broader range of asset classes, including stocks, futures, and options, making it suitable for multi-asset trading. One of the significant improvements in MT5 is the inclusion of an integrated economic calendar and advanced order types, such as fill or kill, FOK, and immediate or cancel, IOC, which provide greater flexibility in order execution. MT5 also boasts a more powerful backtesting environment for automated trading strategies, allowing for multi-threaded and multi-currency testing, which can lead to more efficient and accurate optimization of EAs. Despite the advancements in MT5, many traders continue to prefer MT4 due to its established presence and the vast ecosystem of third-party tools and customizations developed over the years. The MQL4 programming language used in MT4 is different from the MQL5 language in MT5, meaning that EAs and indicators are not directly transferable between the two platforms. This has led to a slower adoption rate of MT5 among traders who have invested heavily in MT4's ecosystem. Additionally, some brokers offer only MT4 due to its widespread popularity, further reinforcing its dominant position. However, MT5 is increasingly being recognized for its superior performance and expanded capabilities. It supports more timeframes and built-in technical indicators compared to MT4, providing traders with more granular analysis options. The platform's enhanced market depth feature offers a more detailed view of market liquidity, which can be crucial for traders employing advanced strategies. MT5's improved interface and additional functionalities are designed to cater to the evolving needs of modern traders who require access to a diverse range of markets and sophisticated trading tools. In summary, the choice between MetaTrader 4 and MetaTrader 5 depends largely on a trader's specific requirements and trading style. MT4 remains a favorite for Forex traders due to its simplicity, reliability, and extensive support from the trading community. In contrast, MT5 appeals to traders seeking a more advanced platform with greater multi-asset capabilities and enhanced analytical tools. Both platforms have their strengths, and traders should evaluate their individual needs, including the types of instruments they trade and their reliance on custom tools, to determine which platform best suits their trading strategy. The gold market is in shift. Lot size is a fundamental concept in forex and gold trading, significantly impacting a trader's risk management, potential profitability, and overall trading strategy. In forex trading, a lot refers to the standardized quantity of a currency pair being traded, while in gold trading, it typically denotes the amount of gold, measured in ounces, being bought or sold. Understanding and selecting the appropriate lot size is crucial for effective trading. In forex trading, lot sizes come in three main types: standard lots, 100,000 units of the base currency, mini lots, 10,000 units, and micro lots, 1,000 units. The chosen lot size determines the value of each pip movement in a trade. For example, in a standard lot, each pip is worth $10, in a mini lot, $1, and in a micro lot, 10 cents. Consequently, larger lot sizes can lead to higher profits from small price movements, but they also increase the potential for significant losses. Traders must therefore align their lot size with their risk tolerance and account balance to avoid overexposure. In gold trading, lot sizes are typically measured in ounces. For instance, one standard lot in gold trading often equals 100 ounces of gold. The value of each price movement, or tick, in gold can vary depending on the market and the broker, but it generally follows a similar principle to forex trading. Larger lot sizes mean greater potential profits or losses. Given the volatility of gold prices, choosing an appropriate lot size is essential to manage risk effectively. Effective risk management in both forex and gold trading is closely tied to the selection of lot sizes. Traders use lot sizes to control their exposure to the market. A larger lot size increases the leverage effect, which can amplify gains but also magnify losses. Therefore, prudent traders calculate their lot size based on their total capital, ensuring that no single trade can deplete a significant portion of their account. A common risk management rule is to risk only a small percentage, such as 1 to 2% of the trading account on any given trade, adjusting the lot size accordingly. Another important consideration is margin requirements, which are directly influenced by lot size. Larger lot sizes require more margin, or collateral, to open and maintain positions. This means that traders with smaller accounts need to be particularly cautious about over-leveraging, as this can quickly lead to margin calls or forced liquidation of positions. By selecting an appropriate lot size, traders can ensure they have sufficient margin to sustain their positions through market fluctuations. Lastly, the choice of lot size affects the psychological aspect of trading. Trading large lot sizes can induce stress and lead to emotional decision-making, especially for inexperienced traders. By starting with smaller lot sizes, traders can build confidence and experience without taking on excessive risk. Over time, as they develop a more robust trading strategy and a better understanding of market dynamics, they can gradually increase their lot sizes in a controlled manner. In summary, lot size is a critical factor in Forex and gold trading that affects risk management, profitability, margin requirements, and trader psychology. Selecting the appropriate lot size helps traders manage their exposure to market volatility, protect their capital, and maintain a disciplined approach to trading. Whether trading currencies or gold, understanding and carefully choosing lot sizes is essential for long-term trading success. Gold is moving. Choosing between manual and automated Forex trading depends on various factors, including your trading style, experience level, and personal preferences. Here's a detailed comparison to help you understand the differences and make an informed decision. Manual Forex trading. Manual trading offers significant control and flexibility. Traders have full control over each trade, allowing for adjustments based on real-time market conditions. This flexibility enables traders to incorporate new information and adapt to changing market scenarios swiftly. Moreover, manual trading enhances your trading skills and understanding of the market through direct experience, providing the opportunity to develop and refine your strategies and techniques. However, manual trading is time-consuming, requiring constant monitoring of the markets, which can be very demanding, especially during high volatility periods. Emotional influences are a major drawback, as traders can fall victim to biases like fear, greed, or overconfidence, negatively impacting trading decisions. Maintaining consistent execution can also be challenging, particularly when dealing with multiple trades or complex strategies. Automated Forex trading. Automated trading, on the other hand, offers efficiency and speed. Automated systems execute trades at lightning speed, capitalizing on even the smallest market movements and handling multiple trades simultaneously without human error. This method eliminates emotional influences, ensuring consistency and discipline by adhering strictly to predefined strategies and rules. Additionally, automated trading saves time, requiring less active monitoring and allowing traders to focus on strategy development and other activities. It also enables backtesting and optimization of strategies on historical data, helping evaluate performance and fine-tune parameters. Despite these advantages, automated trading lacks flexibility, as it cannot adapt to unexpected market conditions or news events not accounted for in the algorithm. The rigid adherence to predefined rules may result in missed opportunities or increased losses. Technical issues, such as software bugs, connectivity problems, or server outages, pose another risk, requiring regular maintenance and updates to ensure optimal performance. There's also the risk of over-optimizing the trading strategy to past data, which may not perform well in live markets, known as curve fitting. Lastly, setting up a reliable automated system demands a significant initial investment in terms of time and money, along with ongoing costs for software updates, data feeds, and possibly VPS hosting. Choosing the right approach. Consider manual trading if you prefer having full control over your trades, enjoy analyzing market data and making discretionary decisions, are willing to invest the time required to monitor and manage trades actively, and value the learning experience and skill development from direct market interaction. Opt for automated trading if you have a well-defined, tested trading strategy that can be coded into an algorithm, want to eliminate emotional biases and maintain consistent execution, have limited time to spend on active trading but still want to participate in the market, and are comfortable with the technical aspects of setting up and maintaining automated systems. Ultimately, some traders use a combination of both methods, leveraging the strengths of each to optimize their trading performance. For instance, they might use automated systems for certain strategies or market conditions while manually trading others. The expert advisor is working. The history of Middle East crises and their impact on gold prices is a testament to the geopolitical sensitivity of this precious metal. The Middle East has long been a region of strategic importance and geopolitical tension, with numerous conflicts and crises influencing global economic stability and, consequently, the price of gold. One of the earliest significant impacts of a Middle East crisis on gold prices was the Arab-Israeli War in 1973, also known as the Yom Kippur War. Following the outbreak of the war, the Organization of Arab Petroleum Exporting Countries, OAPEC, declared an oil embargo against countries supporting Israel, leading to the 1973 oil crisis. The ensuing economic instability and inflationary pressures drove investors towards gold as a safe haven, causing gold prices to surge. From 1972 to 1974, gold prices nearly quadrupled, reflecting the heightened demand for security in times of geopolitical turmoil. Another critical period was the Iranian Revolution in 1979, which led to significant political upheaval and economic uncertainty. The fall of the Shah and the establishment of the Islamic Republic disrupted global oil supplies, contributing to a second oil crisis. The ensuing economic instability and fears of broader conflict in the region once again pushed investors towards gold. Gold prices soared, reaching then record highs of over $800 per ounce by January 1980. The Gulf War in 1990–1991 also had a notable impact on gold prices. When Iraq invaded Kuwait in August 1990, it prompted fears of a prolonged conflict in the oil-rich region. The uncertainty and potential disruption to global oil supplies led to a spike in gold